liabilities. These are present obligations. These are present obligations as a result of past events. These are present obligations as a result of past events, the settlement of which results into an outflow, the settlement of which results into an outflow, the settlement of which results into an outflow of the economic benefits, embodying the entity, of the economic benefits embodying the entity. Now, we will be looking at liabilities later on in details, specifically under IAS 37, provisions, contingent liabilities, and contingent assets. We'll be looking at that later on. But then it is a present obligation, meaning you are obliged to make a payment as a result of a decision you made in the past. So if, for instance, we enter into contract that I should teach you, you pay me $2,000. We sign the contract, whether you pay me at the time that we have signed the contract or not, it has become your obligation. And you're going to pay. Now, once you are settling it, future economic benefits, meaning that your resources, your money. Now, you could pay me in various forms, like you can transfer an asset to me, or you can give me physical cash. So the economic benefit of the entity, of you, is going to flow out. Unlike assets, which is coming in, liabilities flow out usually. Then let's come to revenue. It is defined as the gross inflow of economic benefits. It is defined as the gross inflow of economic benefits of an entity from the sale of products or services, or as a result of a decrease in liability, So note, for revenue, we are getting the money from the core operations of the business or core activities of the business. So that is the gross inflow. That gross inflow is coming from core activities. Then we come to income. Okay, so income. It is the gross inflow of economic benefits to an entity. Gross inflow of economic benefits to an entity, usually from non-core activities. So let me make something clear here. So if we are a school, so let's say this whole floor belongs to us, and we are using about 1, 2, maybe 3, and the rest of the floors we lease them out. It means the rest of, we will account for the ones we are using as owner occupied. Hence, that will be accounted for according to IAS 16. Now, the part we have leased out will be accounted for according to IAS 40, that is investment property. Then the money that we receive from the rent, from the lease, we will account for that as an income and not a revenue. But if a real estate company, that is the job they do, they have the buildings and then they lease it out, then that one, they will not be receiving income, but they will be receiving what? Revenue, because that's their core activity. So it is about the distinction between the core activities and the non-core. If the money is coming from the core operations of the business, then it's a revenue. If it is coming from non-core operations of the business, it's an income. Next one, expenses. What are expenses? What are expenses? Yeah. What are expenses? Expense. Expense. So if you say you spent 20 Ghana cedis to be here today, that is an expense, right? So what is expense? What's an expense? Okay, so let's put it this way. So let's take the definition. It can be defined as the amount of expenditure, incurred in an activity, a process, or an undertaking. It can be defined as the amount of expenditure incurred in an activity, a process, or an undertaking. The settlement of which results into an outflow of economic benefits. The settlement of which results into an outflow of economic benefit. Alright, so that is what you have to understand about expenses. Then the last one, equity. What's equity? That's very simple. What's equity? Accounting equation. Do you remember accounting equation?
Yes.
What is accounting equation?
Like equity equals to liabilities plus assets.
Liabilities plus assets. Are you sure you're not lying?
Maybe.
I'll say maybe. Equity is equal to assets minus liabilities. Because your assets equals the equity plus liability. So equity or capital is the residual of assets after liabilities. That's all the definition. It is the residual of assets after liabilities. The residual of assets after liabilities. Right. So these are the elements in financial statements. And everything we're going to be doing, everything we are going to be doing in financial reporting is either going to be about assets, about liabilities, about income, about expenses, or about the capital of a business. Everything is just centered around this. Right, so this is the thing I'm going to be touching on that. The rest of the issues, like the qualitative characteristics of financial statement, I want you to read it on your own. Qualitative characteristics, financial statements have to be faithfully presented. They have to be consistent. They have to be understandable, like those things. So just read on them, and then if you have any challenge, you let me know, so that I can switch my gear and go straight to accounting standards. And we're going to be starting with